Good morning. As always, it's a pleasure to speak with you. The market has been in a good position of late. I mean, we're sitting at a 2-3 month high. Do you think the uptrend is intact, or would you start to get a bit cautious at higher levels?
I think the risk reward balance is no longer that favorable as it was, let's say, 45 days back, when a lot of stocks had corrected quite significantly. When you look at the market more on a bottom-up basis, we really don't see, where the momentum will come from going forward. If you look at the consumer pharma space, the stocks look very expensive over there. Most of the good quality private banks are trading at reasonably high valuations. So effectively you're left with, some of the beaten down names where if things go right, maybe there is some money to be made. For example, companies like Reliance, regulated power utilities, some of the private banks with large corporate exposure. If there is not much of incremental negative news on the NPL side, maybe these stocks could get rated from where we are. But on a broader market basis, I think the upside is somewhat limited from where we are. If I look at the Nifty 50 index, for example, that is already trading at almost 16 times on a March 17 basis now. So further scope for rating on a broad basis would be somewhat limited.
Okay. Morning, Sanjeev. As always, good to have you with us. Why this dampness of mood? Is it earnings related, or is it that there is a binary event in the form of the Bihar election?
No, I don't think the Bihar election really matters when it comes on a medium-term basis. I'm not really being, wet socks, so as to say. But just that the stocks run up quite a lot. And if you look at valuations, whether it is consumers, pharma, they're just trading at very, very expensive valuations now. So how much more money you can make on an immediate basis on these names? Then if you look at the private banks, the same story. Most of these guys are now trading at 3 times price to book on a March 17 basis. So that's our problem. There is very little upside left in most of the frontline names, and the scope for rating is there in some of the names, some of the commodity stocks, for example, regulated power utilities, Reliance, as I was talking about earlier. But beyond that, I don't see how this market can move up significantly from where we are. So just a question of valuations and what kind of reward risk balance you're looking at current levels, given the fact that you're not seeing too much of news flow on the reform side, the earnings season. You have not seen any great surprises. Thankfully, there have not been any great disappointments also, but it's not as if we are seeing any great upgrades to our earning numbers for now.
After a long time, we've seen the fund flows return back into emerging markets, Sanjeev. Would that not enthuse you that at least the liquidity situation will remain benign and India will continue to get flows for a while?
Well, look at it this way, the reason why we are seeing some flows coming back in the emerging markets is primarily because the expectations of a US Fed rate hike have been pushed back to maybe December or even March, I would think. So you have a global risk-on trade which is going on, and you are seeing some amount of money going back into emerging markets. But whether anything has changed fundamentally, the answer is really no. As far as most of the emerging markets are concerned, most of them still have to go through a lot of painful structural reform phase, and it will take 2-3 years to correct some of the structural imbalances which have got built into these economies. So it's not as if things have changed dramatically overnight from where we were, let's say, 45 days back when things were looking really ugly. People were at that point in time looking at exiting emerging markets completely. So nothing has changed in the last 45 days, barring the fact that the US Fed rate increase has got postponed by a few months. That's about it. So I don't think we should get overly excited, overly depressed just based on some news flow. Things will improve, but it's not as if things are going to change dramatically overnight.
Okay, we have a lot of questions for you stock-wise, because your strategy note says that valuations of quality stocks in consumer and pharmaceuticals continue to remain expensive, which leaves us fewer ideas to choose from at current levels. Now, let me come to the sell that you have, or you remove Dabur from your model portfolio. Is this because it's expensive, or is it because of the Patanjali competition?
It's expensive to start with, and on a medium-term basis, we are quite negative on most of the consumer staple names. For a very simple reason, if I look at India going forward, one call which we're making is lower inflation going forward. And if that is a structural bet, which I think everybody is making as of India, for India now, the top line and bottom line growth of the consumer staple companies will come off compared to what we have seen in the past. So compared to, let's say, 15-20% top line growth and bottom line growth, which has been the norm for most of these consumer staple companies, I think we are looking at a period where you would probably see more like 10 to 15% growth, which is not bad. But in the context of the fact that most of the stocks are trading at anywhere north of 30 times on the March 17 earnings basis, whether that really makes any sense, I'm not very sure. If you look at historically, the trading band has been more in the range of 20-25, when the stocks were growing at 15-20% CAGR. Now that the earning numbers will probably go at a much lower level, should you make a case for 30-35 P? I mean, that's the whole issue over here.
But is there any other FMCG that you will like, for instance, say Emami or Marico, just anything else, competition for Dabur in a very...
Nothing.
Or Godrej?
Nothing.
None of them.
Okay.
Nothing at current levels. The stocks have to correct quite significantly from where we are for us to get excited.
Okay. I just heard you mention a while back that amongst the stocks that could be value creators, Reliance Industries is one of them. What did you make of the earnings this time? And from this $10.6 a barrel GRM, how much of an upside do you see in the quarters to come?
The 10.6 is clearly an exception as far as this quarter is concerned. If you look at our numbers, we are building in significantly lower numbers going forward. On a more recurring basis, we are looking at $9 a barrel for 17 and 18. On top of that, you add about $1.5 to $2 a barrel coming from the coal gasification project. So that's the kind of refining margins we're looking at. But look at the stock this way. It will do about 80-81 rupees of EPS in the current year, and already 40 rupees in the first half. If you adjust for the treasury shares, add about 10% higher. So effectively, you have about 90 rupees EPS for the stock this year itself. So, give 10 multiples, it's already a 900, not too bad. On top of that, you have two big projects which are coming up, which will contribute to earnings significantly in the next 2 years. And we are looking at somewhere about 110 rupees EPS adjusted with treasury shares in a normalized quarter when the two projects will start contributing fully. So in that case, I think the stock can easily go to about 1100 without giving any value for the rest of the businesses, which is shale oil or telecom. Anyway, we are giving zero value for both these businesses, no value for retailing, no value for E&P, etc. So, this is one of the few stocks which I see where you are seeing some amount of decent earnings growth going forward at reasonable valuations. In India, most stocks will grow, so that's not the issue. The issue is what price you're willing to pay for that.
Okay. Well, let me come to another of your themes which defines your model portfolio: lower interest rates, higher financial savings. Well, how do you look at the finance stocks itself? Private sector banks obviously have been everyone's favorite. Is there still value left in that space?
Depends on what kind of private banks you're looking at. So if you look at an HDFC Bank or Instl, I think they are getting more or less fairly valued on a March 17 basis. HDFC Bank would be trading at about 3.3 times. Instl would be almost close to 3 now. So I don't think there's much upside left on an immediate March 17 basis. But these are, compounding stories. So I will continue to have a reasonable portion of the portfolio in HDFC Bank for sure. As far as the likes of Axis and ICICI go, now it's a question of, what kind of incremental news you see on the NPL side. Both of them are trading at about roughly, slightly below 2 times on a March 17 basis. If you see some good news on the NPL side, some of the issues which are plaguing the infrastructure sector, power companies, metal mining companies, for whatever reasons, if the incremental news flow starts getting positive, you don't see too much of damage through the loan loss provision numbers in the P&L, then there is some scope for relating of the names over here. But till the time you have this big NPL overhang, which we just don't know how big the problem is, the stocks will probably continue to languish where they are. So I think it will take another 2 quarters of good news in terms of underlying challenges of some of the companies with bad financials. That starts getting addressed. Maybe you will see some rating of the names over here.
Okay, well, the other stock in your model portfolio that you've increased weightage on is SIPL. This is one pharma stock that has just refused to participate in the up move. I mean, even this year, the SIPL stock is up just about 7% odd. What's been restricting the upside, and what do you think could be the triggers from here on?
Well, 7% is not bad in a market which has not gone anywhere, so I'm okay with that. See, the big issue over here is, what kind of news flow you see on the inhaler portfolio which they have. So there's still a lot of ifs and buts over there. People have different valuations for that segment. Some of the regulatory issues will hopefully come through, starting with the UK and then US going forward. The size of the opportunity is pretty big. Unfortunately, the earning numbers of this company have been somewhat disappointing, barring the last quarter. So that was the first quarter where we saw some, positive earnings numbers. But historically, last 2-3 years, people have been very disappointed by, a big increase in expenses without too much of that really resulting in any great top line growth. For example, there was a big increase in R&D expenses of this company in the last 3 years. So we are looking at a company which is now available at somewhere about low 20s on a March 17 basis, without giving any real value for the entire ADI portfolio which they have, any other opportunity which is there. So I think that is the story which we are looking at over here. The risk reward balance still looks okay. There is still a lot of value that can be created in the inhaler portfolio which this company has.
Okay, you've also removed M&M from your portfolio on the argument that it's already trading close to your 2017 fair valuation. Anything more you want to add in terms of why M&M? M&M actually has not been performing very well in the last few weeks, though it had a fairly decent performance if you look at the last, say, 3 months. Can you compare it to any other auto stock that you might like?
Some of those names which we have removed recently, they were all tactical additions to the portfolio when the market corrected big time in late August, early September. So, we had added Bajaj and M&M at that time. I think M&M has run its course. We are not seeing any real positive news on either of the two segments, whether it is SUV segment or the tractor segment. Second half recovery story looks very, very unlikely. Even the new SUV launches, they don't seem to be creating much of an impact. That segment is becoming more and more competitive. So, 1100 to 1300, I think that's a good enough return in a matter of, whatever, 40, 45 days, and I'm happy, booking profits over there. As far as other stocks in the auto sector are concerned, we are still okay with Maruti, but having said that, the stock is now on the expensive side. It's about 18 times on the March 17 basis, 250 rupees EPS. The long-term story is still intact, but it's not a cheap stock anymore. Tata Motors is the other one which we have in the model portfolio. It's trading at about 3 EV EBITDA adjusted for the value of the of the India business. The JLR part is available at 3 EV EBITDA, so it's a cheap stock, but obviously there's still a lot of issue with respect to what's happening in China. If you look at China data, it's not as if the country is closing down or anything like that. You can see even the automobile numbers for the month of September, the market actually grew about 3% over there. And if you look at the full year this year, it will probably be a slight increase compared to last year when it was very strong numbers for the overall car market, somewhere about 20 million units of volumes. Second half of this fiscal for JLR should be a lot better given they have a slew of product launches over there. Both in this quarter as well as the next quarter. So we'll start seeing some volume recovery over here, and that should maybe a trigger for the stock going forward.
Okay. Just one more, market-related question, Sanjeev. You said that the upside for the market is limited now, but what about the downside? Where do you think that is restricted to? And what could be the trigger that could take our markets to the lows once again?
I don't see any negative immediate trigger, unless and until there is, a complete negative surprise in terms of the US Fed rate, increase in October, let's say, which is highly unlikely, or even in December. I don't think the market is prepared for that. Having said that, I won't be too worried about, one rate hike. What we need to keep an eye on is, what are the subsequent actions by the US Fed. Thankfully, India is a lot well prepared compared to, let's say 2 years back when our current account deficit used to be in the range of around almost 5%. So hopefully it won't have that bad an impact. But the point still remains that, emerging markets are not looking that great on a fundamental basis. There are still a lot of macroeconomic challenges over there with respect to high current deficits in some of the countries or very high current account deficit in most of the countries. So they are still very exposed to any bad news globally, which essentially arises from US Fed rate increase, which effectively results in the sole risk on trade which is going on currently, getting pulled back. And unfortunately, India, falls in that emerging market basket. It's quite a large overweight as far as any active fund is concerned, probably about 5% overweight in general. So any sell-off for whatever reason in the emerging market, India will get impacted. So Downside, my best assumption would be, take somewhere about 5-10% lower from where we are. But having said that, I don't see any immediate trigger for a big correction in the market.
Okay. Well, finally, I wanted to ask you about cement. The finance minister, when he just spoke to one of our colleagues, spoke about how they are going to spend and they are continuing to spend. The idea that at least in the road sector, a bit of expenditure has been sanctioned and is being made is there. You wouldn't want to play any of the cement stocks?
Not at all. They're all terribly expensive. There is a big myth about this whole infrastructure spending and how great it's going to be for the cement sector. Ultimately, if you look at cement consumption, that comes from real estate. And unless and until the real estate market revives in India, I don't think you have much of a story as far as real estate or rather cement demand is concerned. Even if you assume decent cement demand over the next 2-3 years, so you will still end up with a sector where the overall capacity utilization will be less than 80%. Assume a very steep improvement in EBITDA per ton for, let's say, for the like of Ultratech going forward. If you look at the current quarter, which you just reported, 860 rupees per ton EBITDA per ton, we have assumed 1500 rupees per ton for fiscal 18. And even in that case, the company will do 180 rupees EPS. So from 860 rupees per ton going out to 1500 rupees per ton, 180 rupees EPS. At the peak of the cycle, I will probably give 10p multiple, that's a very good multiple. You're looking at an 1800 rupees stock in that case, so why should I be excited about the sector at all? I think, people just make stories, whatever is convenient, sometimes become a consumer play, sometimes it becomes an infrastructure play, depending on whatever is the theme of the day, people make stories.
Okay, that's very candid, Sanjeev, and that's a fair point. We'll have to leave it at that. So thanks for joining us and giving us your view. So that's the word
I know about cement is that these cement mixers are constantly creating traffic jams in Bombay. Somebody is constructing in Bombay. All right, thanks a lot.